and welcome to the latest Captive Review virtual event. My name is Lauren Ingram. If you don't know me, I am the editor of Captive Review, and I'll also be moderating this panel of lovely experts for you today. Before we start, I just wanted to let you know that we will be taking questions. We'll be answering questions throughout the panel, and also at the end, there will be 10 minutes. So if you just go onto slido.com and it'll ask you for a hashtag, and you just put in Captive Review and you can submit your questions there. So please, if you have questions at any time, jump on there. And today I have three wonderful experts with me. Just so you know, this is the first in a series of 3 formation webinars. So this is our first one. Our second one is in a week from now, the exact same time, and another one the week after that. And with no further ado, I want to introduce our panelists today. We have Anne-Marie Tao, the Global Captive Solutions Leader at Hylant. We have Christine Brown from the state of Vermont, and we have Thomas Keist from Swiss Re, who are going to be speaking to us today about where do you start? You know, if you want a captive, what is the first step? Which I think is something a lot of people would like. So I'd like to welcome them all onto the panel. And we'll just wait for the delay until the videos pop up, as always. Hello all, and thank you so much for speaking to me today and speaking to our lovely attendees.
Greetings.
We don't have a bunch of time, and there is quite a lot to get through, because when you're starting a captive, if you're at the first step, you kind of need to know a lot. So I'll jump in with the first question. And you know, I think a lot of people have heard about when they've heard about the concept of captive insurance, maybe it's been mentioned to them by someone, or as a risk manager investigating it, they want to know, how do I start? And usually the first step is a captive feasibility study. So Anne-Marie, what does this involve, and what will it tell someone once they have it?
Sure, great question, Lauren. And when you think about the journey of exploring a captive, it is really starting at the feasibility stage. And as we know, and Christine will speak to this in a moment, but most domiciles do require a feasibility analysis. So starting that journey is really looking around, in my opinion, and selecting experts that you can surround yourself with as you go down that path and take the journey of understanding what's involved in a feasibility study. And really, in my mind, it's breaking it down into a couple of different components. The first one is establishing what we call your core objectives. Do you know and understand what are your objectives for your organization? Whether you're a for-profit, large global organization, you're a not-for-profit hospital system, you are a mid-market manufacturing company, you need to know and understand, what are you looking to finance within a captive, and what does that structure look like? So going through that process involves a lot of different experts. It involves a captive consultant that you can trust, an actuary that can help define the loss funding and financing for the captive. It's working with attorneys and accountants on determining the actual ownership and the structure, whether you want to be a single parent captive, a group captive, rent to sell, whatever that form may take for your organization specifically. And I think one of the most important parts is the domicile analysis. And Christine is here today with us from the state of Vermont and evaluating some of the top domiciles in the world, and Vermont being one of them, and thinking about what domicile is going to be best suited for your organization. And the way I like to break it down is looking at the financial, the strategic, and the operational aspects of doing business and partnering in the domicile. And those are criteria that you need to assess very closely when you're evaluating overall what a structure would look like for an organization. So I always tell people, you want to be thoughtful, you want to put in some of the time. Going through a feasibility analysis should not take 10 days or less. It really should be a thoughtful, meaningful process that you dedicate your time, you dedicate key stakeholders at your organization to review and evaluate this analysis in order to make an educated decision on advancing forward with the process.
Thank you, Anne-Marie. I can pick up a little bit from where you left off. I think one of the critical things that you mentioned was just all of the strategic partners that are involved when you go down this road to determining whether a captive is a feasible option for you. And the feasibility study really is what we would consider the cornerstone to basically help in making you decide whether it's financially viable to form a captive. And we most often partner with captive managers when we're going down this road. That Anne-Marie and her team and many other of our approved captive managers pull all of the information together for us into a package that we require when we take an application for licensure. And one of the critical components, I think, that I would say that we're looking at is the actuarial piece of the feasibility study, which that component really involves taking a look at your loss history and determining adequate funding depending on the risks that you want to put into the captive. But really, even before that, you need to determine, I think, what your risk appetite is, like, you know, and what risks your organization has that you'd be able to put into a captive. I think that's one of the, you know, very basic first steps.
If I can just add to that, from a carrier point of view, so I mean, we at Swiss Re usually provide then the solutions around the captive, right? So be it fronting or captive reinsurance, stop loss solutions, and so forth. But what we see often is that going through the feasibility stage is, of course, the central point in the preparation for establishing a captive. And then in some instances, actually not too few instances, there's no conversion then in the end from the feasibility to actually establishing the captive. And I think what's often missing or maybe underestimated within companies is that basically the getting on board of all the internal stakeholders on this. Because going through this journey means also going into a new area of how you manage your risks and how you buy insurance and reinsurance. And this is something that takes time for companies to actually get acquainted to. So, and by the way, the interesting thing is that you have a various level of conversion rates from feasibility study to actual captives in various regions. So the highest conversion is actually in North America. In the middle is Europe, and the least conversion you have in emerging markets like Asia. And there definitely you can see it's directly towards the question, do the internal stakeholders, do the sometimes complex organizations understand what the journey is here?
I think that's a really good point, because obviously getting a feasibility study doesn't mean that a captive is right for you. And that's why, you know, and I think that it's good for people to realize that just because you're doing a feasibility study doesn't mean you're locked into doing this, because there might be things that are really good fits for your organization and there might be things that aren't. And I know a couple of you mentioned, you know, structure. And I think that's a really important question, because it's obviously one of the big decisions. There's a lot of different options depending on where you're going to domicile your captive. And we've seen an increase in the formation of cells recently, which seems to be an ongoing trend. But what are the most important things to know about structure when you're trying to make that decision, or you're just learning about it? Anne-Marie, do you want to start for us?
Yes, thank you, Lauren. And when you do think about structure, there are really two pieces and elements that come to mind for me. One piece is structure, back to what Thomas mentioned with, is it a fronted captive and you're going to be a reinsurer, or are you going to be writing direct policies? What type of structure do the actual coverage forms take? So that's one element of it. And the other element is what I call the legal structure within the domicile itself. So the legal structure, is it going to be a single parent pure captive? Or are you going to take the form of an association or group captive? And working through that process and evaluating the different options for you really should be a big part of the analysis when we're talking about a feasibility study. It goes back to what I think we've all mentioned. There is the component of knowing and understanding your risk appetite, and then marrying and aligning that risk appetite with the type of organization and structure. Because, for example, here in the United States, workers' compensation is a very large premium spend, insurance spend. And so a lot of organizations try to determine how can we balance and smooth out that cost over time. Some organizations may opt to go down the path of a group structure and share that risk with other like-minded people, whether it's through an association of manufacturers or roofing contractors, whatever it may be, where others are just not comfortable with that risk appetite of sharing risk with others. They might want to retain it themselves and really make sure that they're surrounding with key stakeholders for loss control, risk mitigation, and risk prevention up front. So it does go back and marry in a lot of those concepts through those decision-making tools when you're evaluating structure. And some structures are not available in all domiciles, or the type of risk. You may want to look at employee benefits or medical stop loss here in the United States, and some domiciles don't allow you to write that risk in a captive. So that can help drive your decision making on where do I domicile this. So that's an important element when you're thinking about that actual structure, legal physical structure. And then renting a cell, is that going to be advantageous for you? Potentially in the beginning. And we're seeing a lot more use of cells right now than I think we ever have in captive history. People are going down that path. The hard market right now, the pandemic, it's a very cost-effective solution that you can access pretty quickly. I wouldn't say 10 days or less. You still need to do your due diligence, but it is a little bit quicker ramp-up time versus a single-parent captive. So exploring and starting and getting your feet wet with a cell captive can be a good option for a lot of organizations where they do have the ability to, what I call, port it out down the road if they want to become their own single parent or even a group structure in the future. So I think there's a lot of options. And I think an important element that all of us have touched on is the ability to do the due diligence. Do it up front. It doesn't mean you can't make changes down the road, because you certainly can. And that's the flexibility with a lot of domiciles and working with them. But as much as you can do up front, you're going to save some costs later on if you get the right structure in place in the beginning, in my opinion.
And Emery, just interesting on the cell issue as well. You say you can convert. That does also seem to be an ongoing trend as well, with the increase in cells, with people kind of dipping their toe into the water with a cell and then doing a conversion later on.
Absolutely. No, I'm seeing a little bit more of it. And I don't know, Christine, if you're seeing it too at the Vermont level, but I know with some of the organizations, we're working with one right now in another U.S. domicile, and they want to essentially port it out into their own single parent captive. They're growing. They want some additional control and enhancements in place. And quite honestly, it financially makes sense, because especially going from some cell structures to a single parent, it doesn't necessarily double or triple your costs either. It's, in my opinion, a natural migration.
Yeah, great point, Anne-Marie, and we have seen some conversions lately. That's allowed in our law. And really the intention of the cell structure, I think all along, in the beginning anyway, was to allow people to kind of dip their feet in and see what it's like to manage their own risk and take a piece of their risk internally, without going through the bigger task of forming their own captive. So kind of renting the license of a sponsored captive or another type of facility. I heard recently, because of the hardening market and just some of the issues that people are faced with pricing and rate increases and the like, that the cell option is by far the better option for people who are trying to jump in quickly to react to these pricing challenges. You know, generally, again, as Anne-Marie and Thomas had both mentioned, captives are a long-term solution. We don't want anybody to think lightly of this. It takes a lot of time and a lot of stakeholders involved in the process, the decision-making process, but a cell allows people to kind of get in quickly and see if it's right for them. I get one other thing I just wanted to expand upon with the types of captives. That's an important component is different types of captives require different capital funding up front, and that is also dependent on the domicile that you decide to go with. But you know, a pure structure has a certain capital requirement versus group captives. And as regulators, when we're regulating these different types of captives, one of the main questions that we ask ourselves is who's getting hurt in the end if things don't go right. So, you know, when you look at a pure captive, it's ensuring the risks of its parent. And so if things go wrong, the parent company is going to have to make it right. So we look a lot of times at the financial wherewithal at the parent company level in order to make sure that, you know, they can put additional funding in if they need to basically pay for their losses. When you look at a group captive, that's a little bit different because there are other stakeholders involved. So, you know, the regulatory regime, I think, is we take a closer look when we're looking at group captives, and so there's more cost involved also in regulatory reporting when you're talking about group captives generally.
So if I can add on the cells, the protected cell company structure, I think, you know, from my and I think our perspective, this is really a great solution for exactly the reasons you both mentioned, right? It's quick. It's also something that, you know, eventually you even have an exit strategy that's also probably bearable compared to once you establish the full captive, you're in a different situation. What we did see often is that clients maybe don't or hesitate to enter special purpose vehicles, and they ask us, can we not just rent your balance sheet to do the same? And we have basically developed a solution last year we call virtual captive, where basically they would rent our balance sheet to assume the same, but it's by way of an insurance contract with some structural elements. This is for the same reasons as they would go for a PCC, right? It's quickly established. There is an exit strategy. It has some, you know, advantages and also disadvantages, as everything has. But I think my point is the range of options that are these days available for risk retention vehicles is huge. And it's actually also the perfect situation or the perfect environment to really go into feasibility studies around these risk retention vehicles and possibly decide to start one or the other.
Yeah, I mean, as we've all said, I think cells are such a big trend. We had our world domicile update earlier in the year, and while cells are a little bit more difficult to count accurately, since some domiciles don't count after a certain time, so we know that there's, at least quite a large amount, but that there's probably more. But that was one of the areas where has been really strong growth in the last few years. And one of the other things that we talk about especially when you're structuring a captive, when you're setting up a captive, is rates, retentions, exclusions. They have to be set. And if people don't have as much experience about this, it might seem a bit daunting. So I guess what does a potential captive owner need to know, and how would they approach this? Do you want to start, Marie?
Sure, thank you. And it can be very daunting. I know when I'm having discussions with a lot of clients, existing clients or prospects about this process, it's knowing and understanding, going back to your risk appetite and your risk philosophy, as we've all touched on. And it's an important element. And sometimes, in my mind, you step back even from the feasibility analysis into that, what I call risk optimization, and what is that horizon for you? Because it is important when you think about how do we take what we're doing today and how do we migrate it into a captive. Some people actually get a little bit confused and think about, well, I'm going to just put all my risk in a captive, which is not the scenario. As we all know, you're not going to take unlimited risk in your captive because of capital restraints, for instance. And so approaching how do we evaluate retentions, how do we evaluate lines of coverage is an important element. And that's where you really spend, in my opinion, the majority of the time analyzing what is going to be a comfort level for you, and even evaluating several different retentions, even by line of coverage. This is our approach with many organizations on how do we evaluate it. And we break it down. I think the best approach is starting holistically, looking at all coverages for the organization, all exposures, and then pretty much narrowing it down based on their feedback, their interest, and then outlining, okay, what if we match our general liability coverage today? We take $1 million deductible. What if we fund the $1 million in the captive? What happens if we decide to take $2 million or $3 million or $5 million? What type of relief do we get from the commercial marketplace? And based on our loss history, does it financially make sense for us? And do we have a partner such as Swiss Re or an organization that's willing to partner with us on whether it's fronting or taking some of the excess or reinsurance? And I would say a time commitment, and the stakeholders need to be involved as you're evaluating and working with the actuary, because we're going to, as you know, my actuary friends always say, they're going to collect data, take the past to try to predict the future. And that can be challenging on certain lines of coverage. You know, if you're evaluating cyber risk and you've never had a cyber event, if you're evaluating a property damage and you've been fortunate enough, knock on wood, that you haven't had a wind event or a flood event or something along those lines, it can be very unpredictable. Look at the pandemic that we all just have lived through and the experience. Nobody really predicted that. So evaluating and looking at coverage lines and developing what you called, Lauren, rates, that can be challenging at times. And it's really bringing in the experts, your brokers, your captive consultants, the actuaries, to help define what are those limits going to be and what is the comfort level for the organization. So I think that's an area of the feasibility analysis that really should take quite a bit of time as you're developing the program in order to get, as Christine mentioned, to that outcome, the 5-year pro forma projections, your business plan. You've got to have some thoughtful process in there and evaluate the different options for those assumptions for your business plan as you file it with your domicile regulators.
Can I?
Yeah, I was going to say, Thomas, from a carrier point of view, what do you have to add?
Yeah, just a word of caution. and maybe some expectation management with respect to how your insurance partner react when you increase your retention by way of introducing a captive, for example, especially the first year. When everything is hectic, when you establish that captive, you introduce the restructured program using the captive and so forth. The expectation has to be that you might not get the discount on the premium you pay to the traditional insurance market or then reinsurance market in the first year that you are expecting. This is a experience we see many times. There's a lot of disappointment about that, but the reason is that usually because everything is hectic and tight in time, you do not have much time and choice with respect to the markets you go to basically introduce your new reinsurance program. But the part that is very important is, and this is also, you have to manage your stakeholders towards that, in future, your degree of freedom has increased dramatically by having introduced a captive. You will be able to access new markets which you have not been able to access before. You broaden the choice and you broaden the providers and you broaden the competition. And by that, you might not get the discount you expect in the first year, but certainly in the future. That's a
good point, Thomas. I just want to make a quick point, Christine, before you move on, is that's a question we get a lot of times as consultants, year one, what am I going to save? And we always tell people, actually right out of the gate, the cash flow is actually going to be more because you're going to have startup costs for your captive, you're going to have capitalization costs, and to your point, you may not achieve any savings year one. And it goes back to that thought of it has to be a long-term approach and strategy, which I think is important. Christine, you had a comment?
Yes, thank you. I was going to say the same thing, really, that the common thread seems to be from all of us that this really is a long-term strategic decision that needs to be made. And what we've seen over the last couple of years is exactly what Thomas has described, where things are very hectic and decisions aren't made until almost the last minute. So when we get an application come in with a feasibility study, oftentimes that study includes different retentions at different layers with different costs associated with them. And we can kind of take a look at each scenario to make sure that the funding is adequate and that it makes sense, and give an approval, almost an approval to say any one of these scenarios will work, and come back to us when the negotiations are final, and then we can, approve the final plan, I guess you would say. But it definitely has been that way, where especially in these times, it just seems the negotiations are taking a while, and terms and conditions are not finalized right off. So certainly not when the captive is being formed. It seems a lot of times those decisions are still being made, and at the very last minute decisions are made. I think another consideration that people have to think about when forming a captive is the different, not only the lines of business, but the frequency and severity of the losses in those lines. And often we see that captive owners want to take these more predictable frequency layers, like the deductible and self-retained risk at the lower levels, and then the more volatile excess coverage they will lay off onto their commercial partners. But I think another important point that was made was this is a partnership with the commercial insurers as well. So you're not going to take this risk on all by yourself. So the captive is a piece of a bigger insurance program. and with partners like Swiss Re and other reinsurers or fronting carriers. So there are a lot of people involved in the negotiations on what's right for you.
And I guess, again, it just all comes back, like you said, Anne-Marie and everyone else, that it's the feasibility study where you're going to work out a lot of these things and where you're going to determine that risk appetite and decide what's best for you. And that it takes time. You've got to consider your options, and you've got to do the work and the study, and can make a decision. So another essential consideration when forming a captive is also, obviously loss trends and reserves and how that impacts a captive structure. So what, I guess, is the most important thing to know about this? Would anyone like to start?
Sure, I can start. And when you think about and evaluate the loss trending and reserves, I think Christine just mentioned when you look at frequency and severity. So looking at your loss history is extremely important as you're evaluating the type of reserves and actually the length of those reserves. Because when you look at and evaluate longer tail, what we call longer tailed risk, such as workers' compensation, that reserve is going to be on your books of the captive for quite some time. It's not going to be released off the books of the captive immediately. So in my mind, and what I like to see, and I'd be curious on Christine's comments too, is it's nice to have in a captive a blend of what we call longer tail and shorter tail risk, because if you have something like a property or maybe even a general liability, professional liability, or auto liability blended, then you have the ability to mix and match, and you have ability to balance it out within the captive itself, because you may have losses more frequent on one line than another, but it helps balance out what we call the portfolio and even the reserves. And I think that's a nice approach for many organizations. Instead of being focused a lot of times in just the wider organization of captives, you hear the thought, well, I just want a property captive, or I just want a medical stop loss captive. And, I pause sometimes and ask the question with people who are discussing it of, well, have you considered and thought about potentially blending in more risk? Because it might be advantageous versus having just one line of coverage. And especially in a group scenario, in my opinion, if you have a property captive and it's in a certain part of the country or the world, then they could all be essentially experiencing claims at the same time. If you have a dramatic event that happens, with business interruption or supply chain, something along those lines. So you've got to think about these areas when you're evaluating the loss trending, the reserving, and what does this mean and how does it impact the financial viability of the captive. So I think, Lauren, it's an important question, and people need to take the time to consider, what are we focusing on and how does it impact the financials? Will I have to recapitalize the captive because there's an opportunity, not an opportunity, but there's a chance that with these considerations, with the risk, that it would really generate large losses? And how do you provide that protection for the captive itself with the lines of coverage and the reserving methodology, but also blending in, as Thomas mentioned, who are your carrier partners and where are you actually providing excess protection? For example, it doesn't always have to be that primary layer of risk you're evaluating. You could stand side by side and take a quota share along with Swiss Re on a higher tower of risk. Let's say on the property, you want to take the 10 million excess of 50 million and take a 25% quota share and stand side by side with Swiss Re and other reinsurance partners. So there's a lot of ways, as I call it, you can slice and dice and how you evaluate and make the captive. And it's going to be different for everybody. Each and every one of them, I always say, is customized for their risk appetite. Even if I'm a hospital system and Christine owns a hospital system, I might be more comfortable at retaining $100,000. She might say, I'm going to retain $500,000. And she might be in Vermont, I'm in Indiana. There's different exposures and different laws. And if I have operations over in Germany, and what does that mean, and how does it impact those loss reserves? So it's evaluating and goes back to that risk optimization. And in my opinion, it's always making the captive core and central to all of those risk buying decisions.
Yeah, excellent point, Anne-Marie, especially with regard to, I think, diversification of the lines of business. You know, often in group captives, we do see with, you know, that they have a monoline kind of coverage, professional liability or general liability. But it does add to the risk a little bit. And, you know, when we're looking at captives, we do risk assessments ourselves as regulators to determine, you know, if funding is appropriate, if capital levels are appropriate. Anne-Marie had mentioned the, you know, financial projections. And when we get the feasibility study, along with having kind of a projection of the expected scenario, what would happen if losses develop as expected per the actuaries. We also require a projection of an adverse scenario, which is basically a stress test that we ask the captive to go through where losses develop unfavorably and what would happen if you're pricing conservatively. Maybe you're able to build up surplus so that you can absorb a loss. But, you know, in early years, the risk is a little bit higher that you might not have the capital built up to be able to absorb the loss. And then what happens? You know, who's able to put the money in if more money is needed? But the loss data and, you know, your historical loss data is important in that it really does help determine that, I guess, pricing for your specific risks. So in addition to using industry data and modeling, you know, which has really, I think a lot of brokers now have their own proprietary proprietary data modeling that they can use for pricing, it's still very helpful if you have your own loss data that we can look at to kind of gauge, because sometimes, a lot of times actually, captive owners, their loss history is better than some of their competitors. So, you know, that's kind of why they're looking into a captive too, because they think the rates that they're being charged really don't reflect their risk. So a captive is an excellent way to be able to fund for your specific risks and your risk management strategies and loss control.
I think what's left to me to say is then, I mean, you've said it all, but in summary, what in terms of having the different lines of business in the captive, looking at loss trends and using diversification effects. I mean, obviously, reinsurance is like a capital surrogate. So if you buy, let's say, stop loss reinsurance, you basically buy a capital protection, and you buy it instead of adding additional capital to the captive. That's why I'm saying reinsurance is like a capital surrogate. And obviously, to Anne-Marie's point, with respect to the diversification effects, also when you buy stop loss reinsurance protection to protect your capital, you benefit from diversification effects if you buy the stop loss in form of a cross-class stop loss, for example. And that's why it's beneficial to really use these diversification effects.
Excellent point. I think I'll just add to that, as a regulator, one of the things that we do look at when we look at funding is your net retention. So when you have highly rated reinsurance partners, it does make a big difference when we're looking at how much capital and funding do we want to see in the captive.
I think that we've gotten through a lot, which is amazing, but we also do have quite a lot of questions that have come in. So we'll switch to those. So we've got a question here. What are the pros and cons of a captive versus a large SRI program in your view? Does anyone want to jump on this first?
Yes.
Anne-Marie? Or Thomas, I'll get you all going.
If that's okay with you, Anne-Marie, I start.
Go ahead, Thomas.
So this is actually an excellent question, right? And it's the first you should ask yourself, and always. And I think there's two key points there. First of all, using an insurance vehicle for your risk retention strategy allows you to set up loss reserves, and it allows you to set up reserves also for certain future events that might happen, which is only limited to a limited extent possible on your balance sheet, on your corporate balance sheet. So this is the first. Sorry for that. This is the first of the 2 points, and the second point is never forget insurance has values that go beyond just paying claims, and the value is that the insurance an insurance program pays losses where they happen, and especially in the context of an international program. So if you have an international program and you start to increase your deductible in various locations, let's take the example of, let's take Chile. Assume you have an entity in Chile and you just have a huge deductible there. You know that the entity might not be big enough to actually sustain such a large loss. So you need a mechanism that helps them out and pays for the losses they may sustain. If you don't have an insurance vehicle, it's sometimes not easy to transfer the respective capital to these kind of locations. There might be a lot of tax implications and so forth. Insurance, on the other hand, and insurance programs, they are a very established mechanism and way of paying money where it's needed based on losses. And that's something that you don't have if you just increase your deductible in the various locations. You do have it when you have a captive insurance program.
Does anyone want to add anything to that, or shall we?
Yeah, I think Thomas hit the nail on the head. There's just a lot of long-term benefits by utilizing that strategy. So we could probably look at some of the other questions.
There's a lot.
Yeah.
So I think this one is a good one. So what do you see as the main reasons why clients don't proceed to form a captive after having conducted a feasibility study?
Sure, I can take that one. I think what I've seen in all of my years of experience, there's a couple of reasons. One, financially, cash flow. And we talked earlier about capitalization being deployed into the captive. And of course, the premium costs, additional startup costs still to get it operational. So I've seen organizations go through the feasibility and then determine it is, potentially a good solution, but now might not be the right time. There might be structural organizational changes happening, such as an acquisition, a merger, an IPO. I had an organization going through an IPO. And so they said, we really want to do this, but we're going to table it for 12, 24 months and then proceed. So I think that's really one of the biggest reasons is the financial cash flow aspect. And then the other, back to what we said at the beginning, it's not always for everyone. You might go through the analysis and it doesn't make sense for an organization. It's not financially viable, meaning that there's not going to be the right type of benefits that an organization thought that they had, conceptions that they had going into it. So that's one other area that it just doesn't make sense. And what goes hand in hand with that sometimes is the education of the key stakeholders, meaning the C-suite. If you're talking about a large global corporate parent, they might not have enough education throughout the decision makers. So for example, if I'm working with a risk manager and maybe a CFO, but not all the other stakeholders or the board that need to make the decision. They might not be educated enough on captives in order to essentially make an educated decision on it. So that's a hurdle sometimes of why people I've seen do not move forward with proceeding. I don't know, Christine, if you have any other thoughts, but I think those are the big reasons, in my opinion.
Yeah, that's generally what we hear, Anne Marie, is either, you know, it's determined that it's not cost effective at the end of the day. Sometimes there's, you know, just a lack of initiative, I think, when it comes to loss control too. And, you know, it really is a commitment, and you need to want to make that commitment for risk management. Most of the companies, or all of the companies that form captives, want to be in control of their losses and their risks. But if you don't want to have that as part of your oversight, then sometimes that isn't really, a captive option isn't really best for you. And then, yeah, as you said, the education piece, I think, is a big part of timing. And sometimes that just takes time. So it's on hold until people can get up to speed with understanding the benefits of a captive.
Just one point that not mentioned, and I want to stress it, is really the perceived lack of sufficient premium discount on the commercial premium you pay for your traditional risk transfer, and that's often a stumbling block. And I'm just saying, you need to be able to manage expectations and make sure it's understood as a long-term investment, and it increases your degrees of freedom in future.
Right. I think just to add to that, you know, when we're looking at the hard market now, anybody that's had a captive established and has been able to build up surplus over the years because they're priced adequately, you know, it's not about having lower premium in your captive. It's really about funding adequately, which, to Thomas's point, can oftentimes be almost identical to what you might be seeing in the commercial market. But, you know, now when you get to a hard market, you have capacity to be able to write lines that aren't available, or if you're seeing huge rate increases, your captive can come into play and help. So exactly that, Thomas. I think managing expectations so that people know it isn't about saving money initially. It's about building up surplus and building up funding. And then, you know what, if your losses develop favorably, you can potentially take some of that built up capital out in the form of dividends, or lower your rates in the future once you've proven yourself.
So the next question, I think, is for Christine. So it's, to what extent would the regulator be involved in changes to the structure later on?
Sure. So we're very involved in any changes that happen after a captive is formed. So we don't take an advisory role. That would be up to our captive managers and other service providers like Anne Marie. But when a captive is considering a change to its structure or its business plan in any way, different lines of coverage being written or limits, they need to get prior approval from their regulators. So we have conversations with people all the time, and you know, even though we don't give advice, we do brainstorm with people about different things that they're thinking about doing in their captive, because we've seen so much. We're able to kind of share what we've seen work and doesn't work, and ultimately any change though would require our approval before moving forward.
And I think
that's a good. I'm sorry.
I was just saying, that's what Anne Marie said earlier, which is just that, you know, there really are a whole group of people that you have to consult and get those experts, and it's not just one person who's going to tell you do this, and it will be okay.
Exactly.
Yeah, I was just going to add, Lauren, one point based on what Christine mentioned from the beginning and the outset of when you do apply for your initial license, is we really encourage our clients, the captive owners, to have an open dialogue with the regulators, as Christine mentioned, because it's not only beneficial in the beginning, it's also extremely beneficial as you're going through those business plan changes and really evolving into that strategy, as Thomas mentioned. And it's important to have that open dialogue and keep them informed, because they have ideas sometimes of things that they've seen. And I know sometimes the European domiciles are operated a little bit differently than some of our US or Caribbean domiciles, but I think in general, regulators want to be informed of what's happening and have that open dialogue at a minimum with your captive manager.
Yeah, I think just to add to that point, it does make things easier when we have an open dialogue and that kind of relationship built up with our captive owners and captive managers, where you know, if we're hearing about things that are going well and just understanding the business plans of our captives, when things don't go so well, it's a lot easier to give us a call and try to work through solutions. We're not here to be obstacles. We want the captives that we regulate to succeed. So we're here really to try to facilitate that as best we can within our regulatory framework. So the more open dialogue we have, the better. Exactly, Anne-Marie.
So yes, there's another question here. Can you go into a little more detail as to what the actuary's role is during the feasibility analysis? So that's from Jacob. So thank you so much, Jacob. Do you want to take that one first, Anne-Marie?
Sure. When you think about the actuary's role, it's actually very critical as you're evaluating and doing the analysis in the feasibility stage, because you want to look at and evaluate, and most domiciles in the world do require a third-party actuarial arm's length review of what that pricing would be in the captive. So when you think about their role, it's collecting the data, evaluating along with the captive consultant what program limits, how do we rate what is going to be the program, whether it's a professional liability, a property program, a workers' compensation. And they're essentially helping to establish what that loss funding or loss pick, as we say, is for that experience, and looking at developing into the premium dollars that would go in and be paid into the captive, along with giving their opinion on the capital that would be required based on the lines of coverage. Because if you're looking at potentially a cyber product in the captive versus a workers' compensation versus a general liability, and if some programs are fronted or they're not, there's a varying role on capital that's required based on the program. So the actuary actually plays a very big part of the analysis. And as Christine mentioned in the beginning, the regulators spend a fair amount of time reviewing the actuarial analysis to help support the numbers, because it is really driving that business plan.
All right, we'll continue on because we've got a few questions and not that long, so I don't know how much we'll get through.
Okay.
But thank you so much. So we've got another question here, and this is a massive question, so I don't know if we could answer it in a couple of minutes, but can you comment on how recommended it is to use a captive for D&O cover? Particularly, can you comment on the impact of non-indemnifiable losses for D&Os? I mean, there's entire panels on this, but if anyone wants to give a 5-minute answer.
Sure, I can start, and obviously Thomas and Christine can give their commentary. We're seeing more interest, I would say, as we've come into 2021 in the D&O area. Christine knows we have a common client that we've been talking to that is interested in taking on some of their D&O cover in the captive. And this could be a primary layer, or potentially what we're really looking at, for instance, is side B and C. We don't see side A always being in the captive because of that really what I call circular transaction of indemnifying yourself. So if you look at side B and C, for example, we're working with a client right now where they may take outside of the primary, because it's fronted, they're looking at taking limits up to $60 million of B and C in the captive. This captive is obviously heavily capitalized and has the surplus available to be able to do that. But I think we're going to see more interest, in my opinion, in utilizing the captive for D&O cover, because the rates this year are increasing dramatically in this area. And so I think a lot of captive owners are exploring what layers can I put in. B and C, I think, is a no-brainer from that perspective sometimes, as long as they have the capital and premium pricing to support it. That's really what I'm seeing from our perspective right now.
So just from my side, so what and that's more of a personal opinion, because D&O is such a special line of business, and it is so also a very involved line of business with respect to internal stakeholders. Obviously, I do not recommend to have D&O standalone in a captive. So I wouldn't recommend to establish a captive for D&O only. So if you have already a captive and think about adding that line of business, that's a different story. So that's the first thing. Second thing is, obviously, side A is a problem, or is a problem. There are issues, there are open questions, there are uncertainties about these non-indemnifiable losses for D&O, and you know, they are not. I think maybe from a regulator's point of view, you can answer some of these questions, but usually it depends so much on jurisdictions, on also the company's organization. So side A is definitely a very, very difficult part to be part of a captive, and there need to be other solutions.
Yeah, I would agree there, and I don't really, you guys covered it pretty well. I don't have much to add to that if we want to move on to the next.
Yeah, we have more questions coming in, so I will just quickly say there's a question here about the low interest rate environment and governing investment policy. In our third webinar, we will be talking about that, so tune in to that. And I think we're almost at the end, unfortunately, so I don't think we'll be able to get any of the other questions through. But I don't have anyone's, obviously when you use Slido, we don't have your contact details, but please, and it's anonymous, so please, email any one of our panelists, and I'm sure they would be more than willing to answer your question, because unfortunately we have run out of time. But yeah, also we will be doing 2 more formation webinars. So if you tune in next week and the week after, we'll be expanding on this issue, a very big kind of education point of how to form a captive. So Anne-Marie, Thomas, Christine, thank you all so much it was a very, very interesting session, and I think we got through a lot considering the time. So again, yeah, thank you so much. And again, please contact Hylant or Swiss Re or Vermont if you do have, you had a question we couldn't get to. And they will be able to help you out.
Excellent, thank you.
Yes, thanks everybody.
Before I go, I'll just say there's a link in the chat so that you can register for the upcoming webinars if you want to watch those. As I said, they're on the next 2 Wednesdays, and we also have another event coming up, which in May, which is our Power 50 social. So if you're interested in that, the link is also on the Captive Review website. And thank you so much, and I hope you all have a wonderful rest of your day.
Great, thanks, bye-bye.
Bye.